My commitment to you today is to introduce a few ideas regarding our changing environment on several fronts. The greed and the good, the green and the global, the rush for gold in 2008. Between the lines, my fellow investment team members will give you some of their best analysis on 2007 and projections for this new year. Oftentimes at presentations like this, I sit where you are and think to myself, okay, McCaffrey, tell me something I don't already know. So here you go. 3 things you likely didn't know when you walked in here. Number 1, the bar will open in less than 15 minutes. Number 2, all top 5 nominees for Car of the Year at the LA Auto Show were hybrids. Number 3, the government of Dubai controls nearly 20% of all NASDAQ holdings. Remember Gordon Gekko in the movie Wall Street when he said that greed, for lack of a better word, is good. Greed works. Once again, greed took control and Wall Street demonstrated their genius for packaging mortgage-backed securities, CDOs, SIVs to generate enormous fees. This time, the results have been sobering. Moody's and S&P accused of wholesale failure on rating these issues. The FBI investigating investment banks. Speculation run rampant. Home builders on steroids. Land prices unbridled. Lenders that ignored risk and put approvals on autopilot. Fannie, Freddie, and major banks writing off billions. Buyers retrading, sellers running for the sidelines, the Fed on a slash and burn campaign. Give us a break already. Much of this drama, one could say, does not affect commercial property, but it has. I think the real bogey here is our federal deficit that threatens our dollar in the global economy. It's been said by critics of Wall Street that our system has now privatized profit while socializing risk. In other words, let the taxpayers take the hit when the wheels come off. So now what? What we are dealing with here is not a liquidity problem. It's repricing of debt. And oh yeah, risk. Repricing creates indecision in our current real estate market. Uncertainty stymies investment. Speaking of the market fundamentals and hindsight wisdom on the residential debacle, Tony Downs, fellow from the Brookings Institute, said, "The basic cause of the breakdown in underwriting was immense competition amongst investors with excessive capital, given no time to complete normal due diligence before having to commit funds." Sounds very familiar.
As far as the investment market goes, with some specific interest in the industrial market, I think 2007 started with a flurry, and that carried on through the summer, and we had a lot of action and a lot of interest from investors buying, and a lot of sellers really taking advantage of the dynamic market. And I think 2008 we're going to see still continued high volume.
So in 2007, the office market was greatly impacted by the change in the financial services market. We expect developers to really hold their face rates on new construction. With the rising cap rates, they need to offset that with a higher income level. We expect continued interest from national investors, though. Twin Cities still has a strong economy and a highly educated workforce.
The institutional investors have leaned away from the non-traditional and steering back to the long-term institutional product. In terms of 2008, investors will look at each investment on a case-by-case basis. There will still be demand for retail properties, but cap rates will be higher than they were in the beginning of 2007.
Also, I think that we're going to see a lot of investors interested in that mid-city industrial. You know, our road systems are jam-packed, and being that core city industrial product that can really help and distribute to the whole market without the road issues and the traffic issues that go on, especially with higher gas prices. There's an opportunity here for an investor to say, okay, we got occupancy levels such that I can grow occupancy, I can grow rents. That's how one makes money in real estate, and that's how one makes money in real estate investments. So I think investors should be enthusiastic about 2008.
Overall, apartment vacancy rates are under 5%, due in part to a lack of any significant new construction. To support new stick frame construction, rents typically need to be in the $1.65 a square foot range and above $2 a square foot for mid or high-rise projects.
We are beginning to see new construction for several reasons: low vacancy rates in most areas, increasing rental rates, and the virtual halt of concessions. While rents haven't increased enough to justify new mid or high-rise construction, there is a growing case for new development of garden-style or low-rise projects, especially in uptown and transit-oriented districts.
Challenges developers will face are the lack of available infill in suburban apartment sites, municipalities' desire for sale and mixed-use projects versus rental housing options, and neighborhood opposition to high-density development. These and other issues will continue to hamper the entitlement process, making new construction difficult this year.
We're confident these trends will keep us from repeating a cycle of overbuilding this year, with occupancy rates at all-time highs, concessions at a minimum, and continued rent growth. Look for cap rates to remain low and continue to drive the demand of multifamily sales in the Twin Cities in 2008.
In talking to developers and active buyers, it's my observation that we have entered a new cultural awareness of greener attitudes that will demand rethinking much of what we do. Real estate investing is no exception. My suggestion to you is this: call your property manager and take them to lunch. Well-versed green property and facilities management expertise just became more critical to preserving economic value. Corporate and institutional capital will respond to the demands of their stockholders, feeling the pressure to buy and lease green real estate. Will this have an impact on value? No doubt about it. America faces a new global codependence that we have not experienced before. The classic standoff between growth of our economy running head-on into heightened energy conservation. Going for the gold in 2008. Indeed, it will be an interesting year to see who gets the gold in Beijing and who gets voted off the island at the political conventions this summer. Indicators point to a very competitive year, perhaps fewer Olympic-class sprints this year, but rather back to more deliberate underwriting and seeking out core product. Foreign investment? Yes, as our overseas friends, private and wealthy governments, see America as a blue light special. Witness the sales of Fifth Street Towers to a London REIT, and Opus's sale of the Cargill buildings to a German fund. So for 2008, some predictions. Debt analysis is certainly back. We see replacement cost and exit cap rates as key factors in underwriting. We see institutional equity seeking more joint ventures. We see cap rates slightly higher, 25 to 50 basis points on Class A product and 75 to 100 bips higher on Bs and Cs, plus more equity will be required. It's been said that this is a needed adjustment to make our industry stronger. I would agree. With the Twin Cities bias, we see capital seeking the stability and returns this market has to offer. Most investors are moving on. Rates are, again, very low. Spreads are declining. The 10-year is still under 4%, and institutions have lots of money to invest. So let's get on with it. A major research firm just ranked the Twin Cities as entering the expansion phase for both office and apartments. Minneapolis was ranked in Multifamily News as one of the top 10 cities for apartment market improvement. So we expect to see more deal flow in 2008. As Mark Stevens said earlier, we see the potential for a new construction explosion of office product in the western burbs. If this occurs, the effect on Bs and Cs will be dramatic to stay competitive. So hang on for some exciting times here in Lake Wobegon, where our workforce is the most literate, our deal quality is good looking, and the investment returns are above average.